I'm Owen Bigland. This is the Inside Edge video blog. Okay, I've had a few people on my channel here ask me about my portfolio, how I've got my portfolio constructed, what the breakdown is between stocks that I own that pay a dividend, so maybe more slower growth stocks that pay a nice dividend versus growth-oriented stocks. High growth, don't pay any dividend, so that would be the Amazons and the Netflixes and Nvidias and that kind of thing. So it's a good question, and there's no right or wrong answer. It's a pretty unwielding question, but let me try and answer it as best I can, because so much of this, my portfolio and the way what I'm doing, might not be right for a 20-year-old. I'm now in my 50s. I've got a pretty good sized net worth. How I invest, I would not recommend for everyone, and I definitely would not recommend how I have my portfolio structured for a 22-year-old tech worker who's working and making $100K a year right now out of school. So let me try and answer it as best I can. If you've read my book a lot, that will give you a door opener kind of to my investment philosophy. I've always looked at my portfolio, and I still, when I meet with people and they ask me about this, and some of the people I'm mentoring right now, I've always looked at my stock portfolio like an apartment building. And I use this analogy many times. I've got a 30-unit apartment building, and every unit is a stock. So in apartment 101 is the Johnsons, Johnson & Johnson. In apartment 304 is the Mercks. In apartment 505 is the Apples. I look at it like that, and every month, for the most part, these holdings in these apartments are paying me a quarterly rent check in the form of a dividend. And the reason I use that analogy, this is something I read in a book probably 25 years ago, and it hit home for me. And that's one of the reasons why the majority of my portfolio, not all, pay me a quarterly dividend. Some pay me a monthly dividend. Because it resonated with me that even through thick and thin, the market's going up and down and up and down, it doesn't really matter, because the income I'm earning quarterly or monthly on these holdings is coming in rain or shine, just like it would if you bought an apartment building and had 30 tenants in there. And that really, as I say, resonated with me because it helps you stay the course. Markets, we've been on a wild ride here in 2020. The Dow dropped, 34% in about 5 weeks. That can be tough to swallow. For me, I've been in this for 30 years. It was no problem. If you followed me on Twitter, I was a buyer at that time. But one of the reasons why I can stay so calm is it had virtually no impact on my dividend income that's coming in every quarter for me. As a matter of fact, I'm going to do another blog on this later. The majority of the companies I hold not only paid their dividend for 2020, but increased the dividend. I only had a couple of companies that froze dividends on me. One of them was Estee Lauder, which has now put it back out. The only other major holding I have that I've got a fair size holding in is Disney. Disney stock has gone through the roof here. It's up at all-time highs pretty much, but they have frozen their dividend. But it wasn't much of a dividend anyways, and Disney only pays it twice a year. They're a bit of an anomaly. Another story, and I'll do a blog on that later on. But my portfolio, let me shed some light on it. First off, half of my net worth is in real estate, and the other half is in equities. I want to point out that I am not a financial planner, I am not a hedge fund manager, nor do I play one on TV. But I like talking about stocks and equities and saving for retirement, as well as real estate, of course. My main job is as a realtor. I'm an expert in real estate and investing and selling real estate. That's my first love. But I also feel that both real estate and stock investing and good quality equities or index investing go hand in hand. They're the yin to the yang, and they play off each other extremely well. Real estate is kind of the foundation. Stocks can also be a pretty good foundation as well, but then you can also get a little bit more growth depending on what you're buying. But the main thing with real estate, the big plus with buying real estate, not only is your principal residence, that's your first step, but down the road buying an investment property is the use of that leverage. Now, this is so taboo for so many people. I've had so many dust-ups in Twitter over the years, and I still go onto Twitter and I'll see people talking about taking advantage of our low interest rates, buying a home, buying your principal residence, buying an investment property, and these haters, they are haters, come out of the woodwork saying that you are taking on too much debt. Sure, over-leverage yourself, good luck when the market crashes, all this other stuff, even though they have no clue what this person's personal financial situation is. None. As I've often said on here, use leverage to your advantage, especially now when you can borrow at 1.4, 1.5, 1.7%. It's incredible. You should be taking advantage of it, but be careful with it. I'm about the most conservative guy there is. I really am. I could take on so much more leverage, but I keep it pretty conservative. You should too. But at the same time, you should be taking advantage of this leverage. That is the real wealth generator. You know, when you buy a property with 20% of your own money and borrow the other 80%, leave yourself a buffer. You know, these haters are going to come out and say that I'm advocating that you take on too much debt and everything else. Don't. But leverage is that is how wealth is created. Use it wisely. That is something that you cannot translate to the stock market. They both have their advantages. The nice thing about the stock market is it's completely passive, pretty much. Real estate takes a little bit more work if you're managing properties, but the big plus with the real estate game and buying real estate and investing in real estate, even if it's just your principal residence, is borrowing that money at historic low interest rates. You can't do that with stocks. You can to some extent using margin, but do not go there. And you're not going to be getting a 1.4% interest rate on a margin account through your broker. But do not buy stocks on margin. Only buy with what you can pay for in cash. But half my net worth is in real estate because I love the leverage, and I've actually done blogs here where I've taken some clear title properties and actually taken out a new mortgage on them, taken the cash and put it in the stock market. The other half of my net worth or my assets are in the stock market. Now, 80% probably of the stocks I own pay a dividend. Some pay a very small dividend, like a Visa or a Costco, which are paying, I think, less. Visa's only paying about half of 1% right now. Many of the holdings that I have pay a very small dividend, maybe less than 1.5%. But then I've got a number of stocks, more mature holdings, that are paying me a more substantial, like a BCE or a TELUS, which are over 5%. Canadian banks, US banks, Philip Morris, Altria. So I would say my average dividend yield on 80% of the stocks I hold pay a dividend, and my average yield, if I add them all up, is probably hovering around 3.5%. So not bad. On $1 million, we'll say that's paying me $35,000 every year in the form of dividends. The other 20% of my holdings are in companies that do not pay a dividend. These are growth names. So these would be Amazon, Nvidia, what else do we have here that don't pay me a dividend? Well, Apple is a pretty low one, but it does pay a dividend. I've got about 20% of my stocks, MasterCard, which I think pays 1/4%. I've got about 20% of my holdings in companies that do not pay a dividend. They are more growth oriented. And most of those, the majority of my growth names, are held in my TFSA. And you should be putting them in there as well. That's where you should be holding a lot more of your growth names, because all the growth is tax sheltered. If it does pay a dividend, if it's a US company, you're hit with the withholding tax, 15%. It's in my book, I talk about it. That's where you want to keep holding more of your companies that do not pay a dividend but are more growth oriented. Now, your percentage of growth names that don't pay a dividend but have potential for a lot of capital appreciation, a lot of that depends on your age. If you're in your early 20s, mid 20s, and you've got a long runway to go, then for sure, I would have a little bit more into those growth names. As you get older though, my age, you're going to want to, and what I like is a little bit more stability, a little bit more dividend income coming in every month. So there's no right or wrong to it. But I would also point out that what I call, you should always have a foundation. and no matter what your age is. So if you're just starting investing, I've laid out my blueprint for where you guys should be. The first step I always say is saving for the down payment on your principal residence. That should be your number one priority. Take advantage of the low interest rates, use some leverage. The alternative is to rent. As long as you can commit to it for 8 to 10 years, buy your principal residence. After that, you should start maxing out your RRSP and TFSA, getting a good handle on that. The third and final step would be to buy an investment unit, but not until you've got, I think, at least 200, 250K set aside for retirement, depending on your age. But I would say, though, no matter what your age, you should have some foundational holdings after your principal residence. And that would be just buying the indexes, buying the S&P 500, buying the NASDAQ QQQ, buying the TSX. I really like the iShares Canadian High Dividend, XEI. That will cover all your bases in one stock and very nice yield to match. So I think it starts with just your foundation. Then, as you move up the pay scale and your portfolio is building, you bought your principal residence, then you can start dabbling in some more individual stocks. And for sure, if you're in your 20s or 30s or even your early 40s, for sure, set aside some money for some more growth names. Maybe even if you want some speculative stuff. But you don't do that, in my opinion, until you've got that foundation in place. You've got the indexed investing, you've got some Apple, some Johnson & Johnson, some good blue chip names, some Costco, some Home Depot. That is your foundation. And then if you want to dabble with a little bit of mad money, for sure, go into the names like Tesla and Netflix. And, I own NVIDIA. It's been a nice ride for me. I also own AMD and some of the other, processor companies. But I would, start with the basics, index invest first, buy your principal residence first, and then for sure, if you want to start going into more of the growth names, go ahead. A good place for that is your TFSA. I'm Owen Bigland. As always, thanks for watching. I'll see you next week.